Hi, thanks for listening to the CEO story. And I just want to have a big shout out to our sponsors, Together CFO. Without their support, we wouldn't be able to bring on all of the great guests that we have. So thank you, Together CFO, for supporting us with the podcast and allowing us to succeed. Hey guys, and welcome to another episode of the CEO story. And today we've got the king of the market cycles, Harry Dent, who's going to be sharing some great information with us on how he is the amazing predictor of cycles, how he does his research, and how he got to where he is today. So, Harry, thank you so much for taking the time to join us today. How are you doing?
Sure, happy to be here, Casey.
So, you are the king of the market cycles. You want to just share a little bit about yourself at a high level, and then we can dig into the background.
Well, when I was in, I took accounting and finance in college because everything else looked like not that productive. But I got into Harvard Business School and I really, we started looking at bigger picture issues. And the thing that came with me, why does the economy go up and down? Why are there cycles? People always say like, well, it just happens. Well, no, the sun comes every morning. There's a very real reason for that. So I dedicated my career after that to understanding what causes economic cycles, and there are clear economic cycles, and they are projectable over the rest of your lifetime. Most economists say, well, I can't predict anything past the next election. And I'm like, well, then you're only focused on politics. And frankly, politics doesn't matter that most because politicians, like people, react to cycles instead of predicting them. So yeah, I've got great cycles. It took me 30 years to put them all together, but there's 3 or 4 cycles that really matter in the economy. And we've been in a bad cycle since 2008. And that's why governments are printing money like crazy, which is not a good solution.
Definitely not. When governments print in fake money backed by nothing, it can only lead to a lot of turmoil and disaster, which is pretty much what we're seeing right now because it seems to have caught up with us. Give us a couple of high-level predictions before we dig into your past history.
Okay. First thing, greatest boom in history. I said it back in the 80s from the beginning, 1983 to 2007, the baby boomer, largest generation in history, not just here, but around the developed world, earning and spending more money as they grow up and peak at 46. It's a number, 46. Now it's closer to 47. This is predictable stuff. On average, affluent people peak maybe 54, less affluent people 43, but 46 is the magic number. So that's how I was able to call back in the 80s the greatest boom in history, even when people thought Japan and Asia were taking over and the US was a has-been. I'm like, no, we have one more big boom to come. And we've had that, but we did have that. And so now 2008, the economy did go in a deep recession, which I not only predicted in 2007, I predicted it 20 years before it happened. That's when the baby boom spending wave, more people moving into that peak spending predictably would peak and we would go into a weaker period. We're still in that weaker period, KC, into 2024 until the millennial generation brings us back up. But you know what? There's more people in the millennial generation, but as a wave of people comparatively, it's not as strong or as long as the baby boom. We already saw the greatest boom in history in US, and we will come out of this stronger than Europe and other developed countries in 2024 or so after we go down further, but we will never see a boom like we saw from 1983 to 2007. And where will that boom come? Is you keep moving, listen to this, very simple, from east to west, from Europe to North America, to East Asia, to India. India is the last big country in Pakistan that will peak. So for decades, I mean, my thing is, Casey, people say you can't predict the future. I'm like, oh, I can't predict politics, but I can predict the demographics of the future and key cycles. Demographics run in like 38, 40-year cycles. Technology cycles are more like 45, 46. And so those are the key things that drive. I can tell your kids what the economy will look like when they're at the peak of their family cycle or spending cycle decades from now. The ups and downs of the economy, I've always predicted. People always thought I was crazy. In the 80s, I got criticized for being too bullish. after the long 70s recessions and inflation, everybody, we'll never get rid of inflation and we run one recession. I said, no, 83 to 2007 is going to be the greatest boom in history. People thought I was crazy. Well, now I've been saying since 2008, no, we're in a downturn. It's not just the US, Europe, all the developed countries mostly.
Yeah.
And it's going to be about 2024 until these trends turn up. And all this government stimulus is actually preventing the economy from getting rid of all the bad debts and zombie companies on the rise, companies that are still alive but can't pay their debt service. Debt is higher than ever despite this downturn. And we've
that's
got
going to
to
be the US government very shortly, right? Because they keep taking more and more debt on, and it's going to get to a point.
Yeah, we're doing all the wrong things only because the government is printing money to protect the economy from going into a recession, which is exactly what we need. Recessions are the opposite of booms. It's like male and female.
We're in recession, but what are your thoughts on the fact that they keep denying that we're actually in a recession now?
Well, we are, but all the stimulus is making it, well, maybe not. And then, of course, they keep stimulating more. Stimulus is the wrong solution. When you grow for a long period of time, you're going to have a lot of companies that misinvest and create bad debts. You have to flush those bad debts. It's like going on a diet if you're 300 pounds, or 200 pounds and going back to 160. And then you're healthy and you can grow again. We have boom and bust cycles. My demographic said 1983, 2007, baby boom, greatest in history. 2008 into 2023, downturn from fewer millennials to spend as much money as the baby boomers. And then, I'm sorry, the baby bust, the Generation Xers, and the millennials will create a boom from 2024 to 2037. Not as long, not as strong as the baby boom, but until we get to there, until we flush all this bad debt out of our economy, we're going to compromise that boom. I'm like, we are killing, the baby boom is killing the next generation, the millennials, because their boom will be compromised by the fact that we won't write off our bad debts and bad companies. Because the government keeps stimulating the economy to prevent a recession. Booms and busts are equally important. Booms last longer than busts historically, but if you don't have recessions, you don't clean out the excesses from the last boom, and you can't boom again. So I think economists are now the stupidest single profession on earth because they think their job is to prevent a recession at all costs. And I'm like, recessions are like the common cold. They keep you healthy. It's not like a flu that attacks from the outside. Common colds you get when you're toxic imbalance, and they make you healthy again. You eliminate your excesses. We need to get rid of all the bad debts from the greatest boom in history so we can have the next boom, which will not be as great, but will be good enough to look a lot better than this.
Yeah, I totally agree with a lot of what you're saying there in terms of peaks and troughs and making sure that the cycles exist, because if we try and suppress them.
Look, God created cycles. We didn't create them. Cycles are inherent in life. If you fight cycles, you're an idiot. I mean, you need to learn, okay, here's a cycle. There's the innovation stage, the growth boom, the shakeout, the maturity boom. This is my 4-stage cycle I use everywhere in economics, in businesses, individual, collective economy. You need to learn to adapt to the cycles. Not what governments are trying to do is prevent a 1930s like shakeout cycle, which will make us healthier again. And what did we do after the 30s? The worst downturn in history. We grew faster than any time in history. Governments are doing the wrong things because they don't understand the economy and the state.
They just came out and said that they didn't understand what was causing the inflation, which is crazy, right?
Well, they just printed trillions of dollars in 2 years. $10 trillion fiscal and monetary in 2 years, and they don't understand why we have 9% inflation versus 1%. That was totally artificial. Here's the difference, Casey, and this is very important to understand. The long inflation of the 70s was the largest generation, unproductive, young, entering the workforce at great cost to incorporate them, low productivity first. That's what caused, that was natural inflation. We weren't printing money back then, except a little bit in downturn. This printed money is totally distorting the economy and preventing it from recovering from this downturn and the COVID crisis, and we're just going to go into a deeper downturn. Because you know what the truth is, Casey? I've been predicting 2008 to 2022 would be a long-term downturn like 68 to 82 and like 29 to 42. It's cycles. Don't fight cycles. Work with them and make them better. If you fight cycles, the cycles are going to kick your you-know-what.
Yeah,
we're getting ready to get that you-know-what in the next 2 years, is my prediction.
Let's kind of switch up the conversation to a little bit more of your background and history and how you became the king of cycles and predicting that. So can you share a little bit about your background and your love and passion for economics and kind of macro thinking to get to where you are today?
Yeah, I in college, I majored in economics. Third course, I quit. Useless. Only the third course was good. The first two introductory courses were useless. It's all theory. The third course was about how the government can print money, create money for printing money. Well, that was the only useful thing I learned. So I changed my major into accounting and finance in college, and then went to Harvard Business School and majored in management and in the broader issues. So, you know, I didn't intend to. I just kind of got the best education for economics. Why? I didn't major in economics. Economics is the worst of all these areas of study I've studied. And I've studied sociology and psychology. I mean, I've had a lot of education and study and read a lot of. Economics is the worst science. Nobody's ever decided or understood, why does economy grow? I'll tell you why it grows, because people are born in generations, back as far as you want to go. Every 35 to 40 years, those generations enter the workforce at great expense until they do, and then they grow up and they earn and spend more money as they become more productive. And then as their kids leave the nest, they stop spending and slow down and then retire and die. Generation cycles was my biggest discovery back in the early to mid 80s. Why the economy was so bad in the 70s, the Bob Hope generation peaked, and then things went down until the baby boomers. And what did it cost to bring the largest generation in history? Massive cost to incorporate these people and train them when they were unproductive. Kids are unproductive. Teenagers are anti-productive. Early adults only start to become productive as they enter the workforce. So that explained to me for the first time in history, because I wasn't an economist and I just looked at truth the way it is. Oh, here's why we had inflation, and here's why we had increasing recessions, and here's why suddenly in the early 80s, the economy started booming. Baby boomers went from expensive, unproductive, freaking teenagers, which anybody can understand, to productive adults, which earn and spend the most money by all economic statistics, 46 to 47 in developed countries. And that will only extend out in the future. It'll eventually be 48, 49, 50. But my first indicator, Casey, was very simple. Birth index adjusted for immigrants, which I can do, very quick calculations, on a 46 lag for the peak in spending of the average person. Duh. And it's
simple, really, when you look at it, right?
Very simple. The bust. And the problem is governments are fighting this bust instead of working with it. Like if I was in a company and it went down, I couldn't create money like the government does. I would have to cut my expenses, refocus on the best markets, do all this stuff. We're not doing that. We're just doing the same old thing and the economy keeps getting weaker because we're not making the adjustments for the new generation, and we're not downsizing debts that are no longer productive. Yeah, we borrowed a lot of money for good reasons, as any boom. In a bust, all the bad debts go bad, and that clears out capital to invest in the future. We're not doing that. The government thinks they are smarter than the invisible hand, which came from the greatest genius in history in the late 1700s. Okay.
So, Harry, tell us a little bit more about your investment side of things. You did a research company, you're a publisher, you've done so much more than just predict cycles in your fantastic career. Can you share a little bit more about the other side of things as well?
Well, I mainly do, Casey, predict cycles. What it's taken me 30 or 40 years to really get down. What are the most important cycles? There's always cycles. There's daily cycles. Okay, we go to sleep, we wake up. That's a daily cycle. How important is that? Well, for waking up it is, but it's not significant for the economy. So I had to filter out over 20, 30. I got right away the generation cycle. I was the first person in all of history to see that new generations will enter the workforce and become massively more higher earning and higher spending as they move into their mid to late 40s. Look, we didn't even have good statistics. I started studying this in the late 70s, early 80s, when the Consumer Expenditure Survey was first created by the US government. We didn't even know when people spent the most money until then. I happened to hit with my kind of open-ended, non-economic insights into generations when somebody finally measured, here's exactly when people spend money. They cost the economy until they enter at age 20 on average, spend more and more until age 46 on average, and this is all moving forward about a year every 2 decades. It makes the economy predictable as new generations do this. Nobody thought that people drove the economy. Everybody always thought, oh, it's government policies. And yeah, communism's bad and free market's good. But most successful countries have been free market since for a long time, since the 30s and 50s. The difference is this generational cycles, which when I looked at them, I'm like, why isn't this more obvious? Economists don't study marketing. Marketers study people and what they buy as they age.
So
economists don't study generational cycles.
When we break it down there, what I'm hearing is you started with economics, you realized it wasn't really practical. You then
I stopped my economic major. I said, this is useful.
So you swapped it out and you kind of learned a different skill set, but with an open mind and still a personal love for economics, and you came back to it at a later time when you developed some ideologies and some thoughts in a different way than the so-called trained experts had learned through their university degrees and PhDs and what have you. So you had a completely different perspective and a fresh set of eyes and different skill set, along with looking at completely different factors of age, of spend, of life cycles, which all make a lot of sense, right? When you simplified that formula, you just thought outside the box as to how long are people living, how much are they actually contributing, and we can use those factors together to give us a range of a sweet spot, let's call it, of how generations will boom and bust.
Yeah. I mean, and first of all, somebody said to me in college, oh, nobody can predict the future because there's too many political variables. And I'm like, no, that's got to be bullshit, because I've already seen clear cycles. And when I started studying, when I realized economics did not have the answer after the third course, what my best course was marketing courses. How do people think? What do they buy? What do they buy over their life?
Psychology, really, isn't it? Psychology.
That's when it went off for me. And then when I looked up when people spend the most money, which is the easiest thing to find if you just look, 46. So the first thing I did was say, wait a minute, what if I do a 46-year lag for peak spending? Oh my God, it correlates with the stock market better than anything in history. I literally almost fell off the back of my chair. It was that simple. I was just looking for the truth. And I realized, wait a minute, we know when people, only since the early 1980s do we know exactly when people, the average person and affluent and not, spend the most money. And when I just said, oh, they spend the most money, it's 46, why don't we lag the birth index where people spend the most money? Duh. I mean, best correlation with the inflation adjusted stock market in all of history. And I said, oh my God, it can't be this simple. And you know what? It is that simple. So another thing I got, Casey, real quickly, and because I do a lot of research, I've studied all of global history. I mean, back before modern history, everything grows, and everything grows in cycles. And what I found, there's always 4 stages. There's an innovation, there's a growth when it first goes into niche markets, there's a shakeout, and then it moves mainstream. It's a 4-stage cycle. Everything happens in that. So once I learned that was more in my business consulting for Bain & Company, the large companies. And then I started consulting to small companies where I actually saw my biggest breakthrough, actually, Casey, was very simple. I moved from Fortune 100, the old economy maturing, to consulting to new ventures. And I saw, oh my God, these are the people creating growth. And here's what they do. And oh, they grow exponentially on S curve. I discovered the S curve, and I discovered why the baby boom, the biggest generation in history, was generating demand for new products as they were young with different tastes. And that's when I in the 80s, in about 6 or 7 years, I figured out economics, not using the traditional formulas, but from those simple insights to consulting to new ventures, appealing to the new generation, which was the big, I wouldn't have known the baby boom was so big until I had to study them for my new venture clients. So it was all by accident.
So let me reframe that a little bit. So make sure everyone that's listening can really digest what you're saying, because you packed a lot in there. So you're working with the big Fortune 100 companies, the 4 stage of cycles that you identified, but then you were able to take that and learn more from it when you went into smaller companies, because there was a bigger variance. And like you said, the S curve was great.
Yes, very simple. The Fortune 100 companies, Firestone and companies like that I was consulting to at Bain & Company, they were dealing with the old economy, the aging Bob Hope generation, and what they were buying, okay? When I started to do the same consulting, basically I got hired by a new venture in California to turn them around, somebody I knew, and I took it. I said, that sounds exciting. Well, that's when I started looking, who are their customers? Oh, they're not the old Bob Hopers. They're the new baby boomers who are in their 20s, who are thinking different, buying new things. That's why they're growing. They're doubling every year. And of course, when any company grows that fast, they get in trouble. I ended up turning around 8 different companies in the 1980s that were appealing to the new baby boom generation. So I discovered the baby boom. I discovered the cycles in business. You discover something new, you grow, you overdo it, you shake out, then you mature when you figure that out. So all of this, my 4-stage model, demographics is the key driver, all of this came out of me moving from Fortune 100 to new ventures in the East Coast and new ventures in the West Coast. All of my insights came from me just following my instincts and saying, big companies are boring. I mean, at Bain & Company, we were steering the largest companies in the world, a bunch of young 27, 28-year-old Harvard and Stanford MBAs, crazy. You would have thought that was great. I liked the work. I didn't like the people I was working with, and I didn't like the old companies I was working with. They had no growth. As soon as I took this job to turn around a company in California, I lit up and said, oh my God, this is growth. New entrepreneurs cause growth. And so I've studied entrepreneurs and demographics ever since. And it was easy after that. I didn't have to try hard after that.
So Harry, what was the tipping point that made you finally switch from the big consulting companies, the Fortune 100, to the smaller ventures? What was the final straw that broke the camel's back?
Extremely simple. I did not like my fellow workers at Bain & Company, and they were very smart. They were the top of Harvard Business School and Stanford. And I didn't like the clients, these old Firestone and National Steel, old, boring, mature companies, barely growing at the economy, no innovation. And the executives, we would do some simple analysis, and these executives would be like, we didn't know that. How could you be a top executive and pay this much and not know the simplest trends in business? I was like, my gosh, I'm in the wrong place. And so when I got an offer to take over a company that was failing in California through a friend, and this company was doubling every year or two and having challenge, I said, I'm in my element now. I was learning faster. I'm dealing with the new economy, not the old economy. I lit up, and I've never shut off since. I did not intend to do that, only because of a friend. I got in this new company, but when I did, I realized, this is where I'm supposed to be. I'm innovative. I'm strategic. I can't do much for an old company that's dying anyway. I can do a lot for new ventures that are gonna fall like flies in the end.
So let me repackage that, Harry. So you didn't feel as if it was a good fit where you were with the bigger companies, and you were looking for something else. Through your network and personal relationships, you created additional opportunities. One that stood out, you followed that, you switched courses, and it all kind of kicked off. But I think a key thing there that I'm hearing is you knew that you didn't like that environment, whether it was the people, whether it was companies, whether it was a mix of everything, and you wanted change. And then you put that out there and you kind of created an opportunity and looked elsewhere, but you made that active decision and then followed through with it. I think
Well,
that's
here's the thing. Here's a better way to put it. Exactly what you're saying. I did what my parents wanted me to do. You know, they wanted me to go to the best school. I got into Harvard Business School. You know, it's not hard to get through Harvard Business School. It's hard to get into the damn thing. Extremely competitive. I did everything I was supposed to. My father was in politics. He had these business people, very astute, some of them Harvard Business School. They told me how to write my application. I got into there. Best thing that ever happened, because Harvard Business School was not rote learning. You get in a class of 80 people talking, reading real life cases and arguing over them. I didn't know I was good at that. I didn't know I was good at getting the heart of issue. I didn't know I was good at arguing and communicating. I didn't know that until I got in that situation. So I lucked out to my father's friend getting to Harvard Business School. It lit me up. And from there on, I said, okay, natural thing, we'll go get a job for a large company. Oh, 1 or 2 years of that, snoring. Oh my God, these glacial, you know, like a dinosaur. Boom, boom. And then again, I got an offer to take over a publishing company in California. They needed, you know, they needed somebody, felt I was the right guy. Once I did that, I'm like, oh, this is my element. Fast change, new ventures, creating the future, not protecting the future. I lit up and everything followed after that. I never had to have any strategic planning after that. One thing led to the next.
Yeah, you follow your gut and you find a place where you belong and you can accelerate, add value everywhere. You feel better because of it. And it's a win-win all round in that case.
But again, the key thing though that happened, which I wouldn't have planned, these new companies were appealing to the new giant baby boom generation. So by studying them, I had to study this new generation. And then that's when the light opened. I'm like, oh my God, the world does not see what's going to happen as this new generation enters the workforce in massive numbers and creates the greatest boom. My first great bestseller book was The Great Boom Ahead. People thought I was nuts. I could already see it, but only because I worked for the right companies that let me see the new customers, the new generation. When I was working for Bain & Company in Harvard Business School, I'm seeing the old generation slowly peaking and dying. I saw the growth. I could see the future by working with these young companies. So that was the best thing that ever happened to me.
Fantastic. So as we look to wrap up, Harry, is there any nuggets that you'd like to share with people just as we conclude the interview?
Yeah. I mean, very simply, Casey. I mean, we've seen, first of all, the real boom peaked in 2007, just as I predicted 20 some years what happened. We went in a deep downturn and governments just went crazy and just printed money, especially the US government. And this entire boom since is totally artificial. Now the stock market's at way new highs when the fundamentals of the economy, which I can predict with my 46-year lag on peak spending, is at the lowest level. This is a huge divergence. This is only resolves one way. Stock markets and financial assets prices go down and the economy readjusts to reality, and then we can benefit from the next boom. If we don't, and Japan's already the thing I biggest fear, KC, is that we end up becoming Japan. Japan already peaked in their baby boom generation in the late 80s, mid 90s. I saw that coming too. I said, Japan's dead. People know they're the greatest country in the world. No, they're at the top of their demographic cycle. We're at the lower end of our baby boom. So that's all happened. And people don't see this is inevitable, that all the growth the US has done, our millennial generation, after this downturn, only brings us back. The best the stock market can ever be is when it was at the top of this boom. And I don't think it'll get back to there. Same with real estate. Real estate, I have a quote, real estate will never be the same when there's more baby boomers dying, because it's a bigger generation, than millennials moving into the peak spending. People, this is so predictable. It's so obvious to me. This is the best real estate prices we may ever see in most developed countries, and people can't buy enough real estate. I'm like,
well, yeah, when you look at BlackRock, they just raised $50 billion to go buy real estate right now.
Let's go buy more real estate, commercial and no, this is going to be a bad deal for a while. And even when it goes down, the difference is every stock boom since the late 1700s, the Industrial Revolution, has taken us substantially higher. Every economic boom. This is going to be the first time in the developed world, not in Asia, not in China, not in India, not in Pakistan, all the growth countries. In the developed world, Europe, we will never see stock prices and real estate prices this high again. So sell and see how far it falls. I think the stock market is going to fall 86% from the top back in November, 92% from the NASDAQ, 86% from the S&P in January 4th. The NASDAQ peaked November 22nd. I think that's going to be a peak we never see, most of us my age at least, for the rest of our lifetime. This is important to know. If you don't know this, you're going to make a lot of wrong decisions, especially investing.
I think that's very similar to what Michael Burry's been saying as well recently, where he's shortening and taking a lot of put calls out on big companies because he thinks things are overvalued as well.
The most overvalued, this makes 1929 top look like nothing. And let me just give you a statistic to end with. Stocks did not get back to 1929 peak until 1954, 25 years later, after the Great Depression, an 89% crash. That's what I'm telling people to look out for. It may not be 89%, but I'm projecting 86% for the S&P if I'm right. You do not sit through this. This is the time not to listen to your stockbroker. I'm a fan of stockbrokers. I've worked with them all my life. Most of the time, they'll tell you to stay the course, and that's the best thing. Don't jump in and out because people bad. This is not the time. Get the hell out of the greatest financial asset bubble. This is everything. This is bonds. This is stocks. This is real estate. This will not end well, and it'll take at least 2 to 3 years to wash this out. Be safe, and you will not regret it. That's my advice. And if I'm wrong, you might miss another 5 or 10% in the stock market and real estate markets that are so overvalued. I can't even compare them to history. They're so overvalued. That's what I'm looking at.
Thank you for sharing, Harry. Very insightful as always. If people want to get in contact with you, what's the best way for them to do that?
Very simple, harrydent.com. We have a free weekly newsletter article from me and my partner every week. And we have a paid newsletter, but hey, get on that if you're smart. But hey, just get on our free newsletter and listen to us. I think you're going to find out that we're going to make more and more sense than all the people thinking, oh, this is just a minor setback. Oh, the government can manage it. The government has printed so much money, they've dug their own grave. That's my point of view.
Great. Harry, thank you for joining us. We will put the link below so people can reach you a lot easier. Thank you for everything.